Hello learners, and welcome back to our lesson today. We have a question here that reads, the following information relates to the business of keepsake traders for the week ended 24th February 2016. So the question requires us to prepare ledger accounts and balance them off. So when you're given this kind of a question, first and foremost, you need to analyze that question very well so that you'll be able to determine which are the affected accounts. So therefore, we start off. So on 24th February, keepsake traders started business with shillings 24,000 in the bank. So clearly looking at that question, the affected accounts there will be capital. We have a capital account and a bank account. Next one is bought goods worth 18,000 by check. Bought goods worth 18,000 by check, and the two affected accounts in this case are purchases. We have purchases and bank. Purchases and bank. Next is 26th. Sold goods for cash 18,900. The affected accounts here are sales and cash account, sales account and cash account. Next is February 28th. Cash sales worth 5,625 Kenya shillings. So the two affected accounts here again, we have the sales account and the cash account. Finally, on 29th, we have a paid commission 900 in cash. So the affected accounts here will be the commission account, commission, and cash account, and the cash account. So having that information makes it easy for one to prepare the T accounts, or in other words, the ledger accounts. Ledger accounts are also known as the T accounts. So with that, we can go straight to the question to give our answer. So we start with the first one, the first account, which is the capital account. Capital account. Remember, we've said they're also known as the T accounts. Why? Because they resemble a capital T. You can just make simple account, that is a capital account. Capital account. So we need to have a column for date, the details, and amount on both the debit and the credit side of this account. So date, details, and the amount. This is the credit side. I've separated the debit and the credit side with the double lines. So capital account, how do you record that? Started business 24,000 in the bank. So there's an increase in capital. This business was not in existence, therefore meaning there was no capital for that particular business. Now we've started a new business, meaning that capital is from 0 to 24,000. Increase in capital, remember, said is supposed to be credit, and therefore we are recording this on the credit side. The year is 2016 and it's in the month of February. 24th is the date. So where did this money come from? Or in other words, it was informal, or where was it kept? So bank. $24,000. And we are through with that. The good thing with analyzing question first is once you open an account, you can cancel so that you'll be able to identify which accounts you have not opened. The next one is the bank account. Next one is the bank account. So we have date column, that is on the debit side. Then you have, this is the date. You have the details. You have the amount. The date. Details. And finally, the amount. Yeah. So this is the bank account. You can always abbreviate the word account with A/C. So increase in money in the bank by 24,000 with debit. Remember, bank account is an asset, so increase in bank is supposed to be debited. This is the year 2016, the month of February, date 24. Yeah, pesa. This money is a capital for the business, which is 24,000. Next on this 25th, we are opening a purchases account and the bank account. And because you already have an existing bank account, we do not need to open another bank account. So we go straight to using the already existing bank account. So bought goods worth 18,000 by check. When you buy goods, this person makes payment, so the amount of money in the bank reduces. Therefore, any reduction in assets is supposed to be credited. Any reduction is supposed to be credited. Any decrease is supposed to be credited. So we record this on the credit side, February 25th. Yeah, where did this money go to purchases before the purchases, and it amounted to 18,000. Amounted to 18,000. Then we are through with that one and that one. So we are left with a purchases. So we open a purchases account. You open a purchases account. So here you have the dates column, the details, the details, and the amount. Date, details, and the amount. This is our credit, this is our debit. This one, yeah, our debit and our credit. So purchases account, remember to always name your account. Purchases account, purchases account. What happened? Purchases were bought. Increase in purchases. Purchases is part of the stock, so in which is an asset increase, is supposed to be debited. So the year is 2016, the month is February, and the date there we are seeing clearly is date 25. Date 25, 25th of February. 25th of February, yeah, these purchases paid using money in the bank that amounted to 18,000. And we are through with that. Next, we have the 26 sold goods for cash, 18,900. Do we have a cash account? No. So you're going to open an account for cash. You open an account for cash. Where we have date, details, amount, separate the two sides, date, details, and amount. Yeah, so is our debit, is our credit side. It's on 26th, sold goods cash 18,900. So you have a sales account, sold goods. So this means a reduction in stock. That means on the sales account we credit. The year is 2016, the month is February, and the date is 26. The date is 26. What happened? How were these sales paid? In form of cash, which was 18,900. 18,900. Next, so we are through the sales account. Remember to cancel. Next, we open a cash account. Next, we open a cash account. We open a cash account. For that cash account, open a cash account. So we draw cash account. They have the column for the date, the details, amount, date, details, the amount is a credit side. Yeah, this is our debit side. So our cash account, cash in the business reducing, cash in the business reducing. Sorry for that. We are on day 26, sorry. Sold goods for cash 18,000. Sold goods. Yeah, so we are receiving. When we sell goods, we receive this cash. So we are going to debit this one. 26th of February, date 26. Yeah. Where did this money come from? We made sales. worth 18,900. We made sales worth 18,900. So we go ahead and cancel that. Remember what we said, the importance of first analyzing the question. And we come to date 28th. Date 28th, cash sales worth 5,625 Kenya shillings were made. Yeah, cash sales. So we already have a cash account and a sales account. We need not open another one. For the cash, yeah, we also debit 5,625. That is on February date 28. Yeah, sales 5,625. Again, the sales account. Remember, we had earlier opened a sales account for date 26, so we need not open another one for date 28. Yeah, the sales, we received some cash, 5,625. 5,625. Next is on date 29th, but before then we cancel that, we strike that one. And lastly, on the 29th, paid commission 900 shillings in cash. So we're going to open a commission account and cash account, and because we already have an existing cash account, we do not require to open another one. Paid commission, so cash in the business is reducing, so we credit that one. Date is February 29. Where did this money go to? Pay for the commission, yeah, which is 900. Next, we open a commission account. Commission, credit and debit, credit and debit. So we have the date, details, and amount. Date, details, and amount. Yeah. This commission is an expense. So supposed to debit that one. Payment has been made. The year is 2016. The month is February. And the date is 29. It was paid in form of cash, 900 shillings. And that's it. Then the last part of the question is balance them off. We're going to start with our extra here. So, how do you balance ledger account? So you compare the debit and the credit side. You start by first, you get the totals of the debit. In our case is 900. The credit side is 0. The credit side is 0. Then you get the difference between the debit and the credit side. So 900 minus 0 is 900. So the side with the lowest total is where you record the balance. So 2016, the month of February, are we told to balance them as at what? No, so you can balance that 29th, February 29th, the balance to be carried down, is 900, and we balance 900, get the totals on both sides, 900. And after that, you record this balance on the opposite side. So this side here, you're going to record on 29th February. The balance now brought down is 900. That is the existing balance for that account, and we are through with that. And you come to the next one, is a cash account. So on the debit side, we have 18,900, 18,900, then 5,625. We add that to get this 5, this is 2, 9 plus 5 is 15, carry 1, 13, 14, so 24,525. So our debit side, clearly looking at it, will give us 24,525, and the credit side is 900. So you subtract the debit side, this is the credit side. Remember, debit is bigger than the credit, so we get the difference between the two. This is 5, this gives us 2. Then we have 15 minus 9 is 6, and 3 and 2. So this will be our balancing figure. So the side with the lower total is where we are going to record this figure, and it is the credit side. So balancing on 29th, the balance carried down will be 23,625. 625. And then you can get the totals for both debit and the credit side. Get the totals for both the debit and the credit side. This to give us 5 and 2. 9 plus 6 is 15. I carry 1 to give us 4 and 2. 4 and 2. This other side, we do the same to give us 24,525. And remember to always bring down the balance. This is on February 29. The balance brought down was 23,625. Balance brought down was 23,625. Next, go to the other accounts. Go to these other accounts. We start off with the capital, the debit and the credit side. Debit is 0, credit side is 24,000. So you can balance that on. The difference between the two is 24,000. 24,000, and this is our balance carried down on February 29. And we get the totals. For both the debit and the credit side. Get the totals. This gives us 24,000. This other side 24,000. And always remember to bring down our balance on the opposite side. So on 29th February, the balance brought down is 24,000. Let's go to the next account, which is the bank account. The bank account, get the difference between 24,000 and 18,000. That gives us 6,000. And clearly looking is the credit side that has less amounts. So we have on 29th, the balance carried down is 6,000. Balance carried down is 6,000. Then you get the totals for both the debit and the credit side. Get the totals for both the debit and the credit side to give us 24,000, 24,000. And always remember to bring down this balance. So the balance is brought down on 29th of February. Balance brought down is 6,000 for bank account. Then next is our purchases account. 18,000 on the debit, 0 on the credit. So therefore, meaning on February 29, our balance be carried down will be 18 minus 0 to give us 18,000. 18,000. Then get the totals. We get the totals for both sides. That is both the debit and the credit side. This is 18,000. And this will also be 18,000. Now always remember to bring down the balances. So bringing down, we have the balance brought down on 29th of February is 18,000. 18,000. And finally, on our sales account, here we have 18,000. We have 18,900, and then we have 5,625. The total gives us 24,525. 24,525. That's our credit side. 24,525. And clearly looking at our debit side is 0. So the difference is the balancing figure. 2016 February 29, our balance to be carried down will be 24,525. Then we can get now the totals afresh for the both sides to give us 24,525 at 24,525. And always remember to bring down 29 balance brought down will be 24,525, and we are through with our question. That is how you're supposed to go through that question. Prepare and balance them off. So we have those accounts there fully prepared and balanced, plus these ones. That is what you are required to do when you come across such kind of a question. That is what you're supposed to do in that type of a question. Bye for now. Hope you enjoyed our lesson today. See you in our next lesson.